Good afternoon, financial professionals. I am Doug Twitty, the Director of Annuities at E4 Insurance Services, welcoming you to the BREW, Building Relationships Every Week. Thanks for tuning in today. For those of you joining the BREW for the first time, welcome. We like to start the BREWcast by celebrating today's national days. Today is National Superman Day, National Peanut Butter Cookie Day, and National Peace Day. I'm going to back up to the peanut butter cookie one real quick. If you've never taken a peanut butter cookie dough, put it in a mini muffin pan, cooked it, and then shoved a peanut butter cup in there, you've never been the hit of the party. That is by far the favorite snack. Today's brew, we continue our June-focused planning series of Annuity Awareness Month. Ken Boothe, the Director of Advanced Consulting Group with Nationwide Life Insurance Company, is joining us today. More and more clients are beginning to inherit the funds from parents and siblings that are passing away. The rules for managing these funds change based on several factors, but we need to learn how to handle that money properly. And Ken is here to help explain the rules around these inherited funds. We encourage you to use the chat box or raise your hand to ask questions. And all attendees are entered into a drawing for a CE voucher and a Starbucks gift card, and we'll announce the winner at the end. So thank you for tuning in, and Ken for joining us today. I'll let you take it away.
Doug. Sure, thank you, Doug. My understanding is that we are here to talk about giving money to the next generation, or inherited money, and what to do with it. So to that end, we're going to look at some of the laws that have been passed the past couple of years, how they affect that, the Secure Act Part 1 and 2 as to how that actually works. And there will be a lot more that I don't talk about than I do talk about today, because this is just an absolute massive piece of legislation, and the consequences of it are just incredible. So anyway, we'll get started, and we'll certainly have time for questions at the end. The Secure Act 2.0, the one that now governs everything and everybody, was as of December 29th, 2022. And the main purpose, they say, is allow participants to save more for retirement. I guess that's probably true. It just had a lot of pieces and parts to it that weren't necessarily, in my opinion, in necessarily a client's best interest, as far as how long you can defer money and that type of thing. We'll talk a little bit about that, though. We have a new spousal inheritance option. As we know, spouses have a lot different rights than other beneficiaries do. The new one is now the election to be treated as the owner, which is beginning this year. And some of the effects of that. Basically, the election to be treated as owner would happen if the surviving spouse is older than the deceased spouse, and that would allow for a longer period of deferral, looking at the deceased spouse's life expectancy as opposed to the surviving spouse. So, trust beneficiary rules, special needs trust with charities as beneficiaries, qualified charitable distributions, QCD. We can now do that with certain charitable remainder trust, charitable gift annuities. The limits on those are not very high, so we're not looking at huge amounts of money, but you can see that we have those discussed on slides 72 and 73. We're going to go through maybe 10 slides today, so there's a whole lot more that could be talked about that we won't, but that's okay. That's why we have questions at the end. And the change the age for beginning RMDs, required minimum distributions, to 73 last year, and 75 10 years from now. So 10 years from then, so 9 years from now. You can take a look at the birth year as to what your RMD age is going to be. Anywhere from 70 and a half up to 75. We're looking at 73 this year, because those are the people that are between January 1st, 1951 and 1959. So we're pretty much in that era at this point. So That's where we're looking at for RMDs. We'll take a look at some of the kind of what you could do before and what you can do now is really kind of how I look at it. The before the Secure Act, we had a commonly referred to as stretch or extended IRA. That's basically allowing a designated beneficiary, which is a term of art, which does mean something. It's actually would be a person or a trust acting as agent for a natural person. So they can use their own life expectancy and calculate the minimum annual distribution. This was before Secure Act, just to be clear. The beneficiary had to take that amount out. That was, in essence, their required distribution for the beneficiary. The beneficiary could always take more. So it was kind of a nice way of giving flexibility and not having to, to take out just a required amount and that's it every year. So the first distribution had, and this is still true, had to be taken by December 31st of the year following the year of the owner's death. We'll take a look at how that's changed too. Beneficiaries who inherited an IRA prior to 2020 can still stretch. So people that do have those out there, you can still use those. You can still use the stretch on the qualified money, the IRA. So that's what used to be. What's changed? And well, let's talk about what hasn't changed. Non-qualified annuities. Nothing has changed with non-qualified annuities. You could always stretch a non-qualified annuity over a life expectancy. Secure Act did nothing at all to change those rules. So non-qualified stretch essentially is unchanged. Life or life expectancy annuitization, you have a 5-year rule. Basically, the life or life expectancy annuitization is the default. That's if you take out money by that date of December 31st. Actually, for non-qualified annuities, it's 1 year from date of death. So that's really the only difference between IRAs and non-qualified. So if you took the amount out within a year, you could begin life expectancy distributions. If you waited and did not take it out within the 1 year of the owner's death, you were lumped into what's called the 5-year rule, which says that everything has to be out of the account within 5 years. So we have we still have spousal continuation with non-qualified stretches, and we have any annuitization beneficiaries continue to use whatever option they selected, maybe a 10-year, 20-year life with something certain, whatever possibility they came up with there, we can still use that. So beneficiaries after the Secure Act, we basically have, except for spouses and a few other outliers, we'll talk about that in a second and a little later on the slide, but 10-year payout is basically the most you're going to have for for paying out for IRAs. So designated beneficiaries. A designated beneficiary, again, as a term of art, it's actually a person that has a life expectancy. It's not a trust necessarily or a charity or anything of that nature. So when the owner dies in 2020, 10 years is the payout window for almost everyone. Designated beneficiaries are people in see-through trusts. So the interesting thing is one other difference between non-qualified annuities and IRAs is through the use of trust. So we see see-through trust there. That's when the trust is acting as an agent for a natural person. When that is the case, basically that's the case if you have all human beneficiaries of your trust. And if you don't have some charity or something else as beneficiary of your trust, that is a see-through trust. It's acting as agent for a natural person. We've always been able to look through the trust to the IRA beneficiaries to be able to determine what life expectancy is. That is not the case with non-qualified annuities. There is no ability to look through the trust and do a stretch if a trust is beneficiary. So I'll repeat that. If a trust is beneficiary, you cannot do a stretch. You're limited to a 5-year payout. So the beneficiary cannot take it over their lifetime. They have to take it within 5 years. Eligible designated beneficiaries, another term of art. It is basically anyone who is a person and meets one of the following criteria. Then they can do a life expectancy or lifetime payout based upon their life. So surviving spouse is, basically spouse has the most rights of anybody to be able to take money out of these contracts. Minor child of the beneficiary. Now, this is not a grandchild, not a niece or nephew. It's a minor child, so it has to be a blood relationship type of child. You also have the fact that a minor may be a minor when they receive the money, but they're not always going to be a minor. So basically, the rule says the child can stretch it over their life expectancy until they reach the age of majority, which is now 21, codified by this law. So at 21, then the child has 10 years from that point to make a full liquidation of the contract. Somebody physically disabled, chronically ill, whenever the owner dies, can take that and stretch that over their lifetime. This is, I think, an interesting one. Person who was older or less than 10 years younger than the owner. So more than likely, like probably brother sister situation, something of that nature, is either older or less than 10 years younger. So that gives you a pretty broad window depending on how the owner is whenever they die. The other one thing that required clarification, and we finally received it, is that it depends on when the owner dies. Do they die, or did they die before or after their required beginning date? So if you died before the required beginning date, the beneficiary has 10 years to liquidate the inherited account. The question was, at the time, since it's been answered, what happens? Do you have to take an amount out or an RMD out as a beneficiary every year following the owner's death? It was finally answered, and the answer is it depends on when they die. If you died before the required beginning date, or if the owner did, you don't have to take out an amount every year. You only have to have the account liquidated by the end of the 10th year. So full liquidation by December 31st, the 10th year following the owner's death. No annual payment requirement. Contrast that with if somebody inherited a contract where the owner died after the required beginning date, then you still have to have it out in 10 years, but you are also required to take an annual payment based on the longer the beneficiary's life expectancy or the owner's life expectancy. Now that's a little different than than most people would have thought. You're still limited to the 10 years, but the question is how quickly do you have to take it out? So that's the lesser of the 10-year period or the beneficiary's life expectancy, which could be less than to 10 years. So the IRS waived penalties, the excise tax penalty, 10% penalty on beneficiaries that take out their RMDs in 21, 22, and 23. And I believe they've now waived for 24 as well. They're kind of, I believe, forcing the Congress to really kind of make a decision on whether it's required or not. And by waiving the penalties, they're trying to kind of make them do that. So we have to look at also what happens when the owner dies, and this is where it gets a little complicated when we talk about when did the owner die. It was before 2019. Remember, we said you can still do a stretch. The beneficiary can do a lifetime stretch. So if the owner dies after 2019, but before the required beginning date, the original beneficiary dies within 10 years of the owner's death, the successor beneficiary has to liquidate the account within 10 years of the owner's death. So not the original beneficiary. Remember, we have original beneficiaries, primary beneficiaries. We also have something called a successor beneficiary who takes over the original primary beneficiary. Whenever they get the money, they could have taken that over. Okay. So still have to liquidate the account within 10 years. but it is a little tweak and a little difference as to how that worked and what we thought before and what we thought after. Some of the explanations that were given.
So Ken, just to jump in for a second. So what you're saying is if somebody passes away here and the beneficiary, let's just say, gets 8 years in, and whether they've taken 8/10 of the money out or taken nothing out, when that person passes away, the next beneficiary has the remaining 2 years. They've got to finish off the original 10-year schedule.
That's exactly right. You
Okay.
only get to stretch it over one lifetime. And that has always been the case. Actually, we never had the 10-year rule before, which is what changed a lot. But you could always only stretch it over one life. So yeah, in that example, they've got 2 years to liquidate the contract. Exactly right. Good clarifying point. So we have the exceptions. We talked a little bit about them before, but the person, like I said, the minor child is the one that really it is different in that they don't get a permanent stretch. They only get a stretch until their 21st birthday, which is not necessarily as great as we had hoped for before. But then you take a disabled, older, or less than 10 years younger. So we take a look at those. The surviving spouse payout options. We've always had the ability to re-register or roll over, however you want to look at it, or however you want to make the definition. So you can either take it into your own name as a surviving spouse, or you can leave it in the deceased owner's name. Whether you would do that or not would depend on whether you needed the money and whether you were older or younger than the deceased owner. So if, for instance, you're a surviving spouse under 59 and a half, you would not want to take that into your own name because any distributions from it would be subject to the premature distribution penalty. So only people, either they know they're not going to ever use the money before 59 and a half, they probably should wait until 59 and a half to take it into their own name. The interesting part is there's no deadline for doing that. So you can re-register anytime. There are some restrictions when we talk about required distributions and what you can actually take out. But for the most part, a spouse can re-register anytime. Spouse could elect the 10-year payout rule if they chose to. They can also be treated as the deceased spouse. We talked about that before. So that is that's now an option. It's not a default. It's not something, it's something you would have to elect. It's not something that comes automatically. So
is there any benefit to them electing the 10-year payout rule if they don't have to?
I can't think of it. Yeah,
Okay. I couldn't either.
Yeah,
I couldn't either. So we've
um,
come across this several times where not the spouse, but where somebody's passed away and they've left their money to a sibling that's older or less than 10 years younger.
right,
And I've seen several advisors that didn't know that made them an eligible beneficiary, and
right,
therefore they were not subject to the 10-year rule.
right,
And then I've seen some after the discussion of that, they still decided to follow the 10-year rule.
right.
And I'm not sure why you would necessarily do that if you could
Well, I
stretch the
mean,
tax implications out
yeah, I don't
longer.
know either. I mean, we go into this, this discussion really with the understanding and the assumption that people don't need the money. There would be situations and whatnot where people do need money. And that's the only thing I can think of, really, Doug, that would make anybody choose that option, because
Yeah.
it doesn't seem to have any real benefit on the surface. So I would agree. Well, I've talked for 20 minutes now, so maybe we can open up for whatever questions or comments, observations, whatever you might have.
Sure.
Like I said, we could go on for 2 hours here, but I know that's not the intent. So we'll stop here.
All right. So while we wait for any other questions, I'd like to remind you that today's brew and our full library are recorded and shared on the brew blog on our website at www.e4.insurance. Ken, what are your thoughts on people that want to place an IRA inside of a trust
Mhm.
when it comes to the idea of at some point it's going to pass to a beneficiary?
Yeah, the one thing that I think people may or may not take into account, but I think they need to remember is that a trust can be a pass-through entity. And by that, I mean, trust tax rates are very high. It's not really the rates that are high, but it's the brackets that are low
Yeah.
because you can reach for an individual, it takes almost a $500,000 of income to get to the highest tax bracket. For a trust, it takes, I think, 15,000. So, I mean, you're in those high brackets really quickly. But the only time a trust really pays taxes is when it accumulates income. So if a trust has income in any given year and distributes that income to a beneficiary, the trust does not pay income tax, the beneficiary does on that money. So if we
Okay.
have trusts that are beneficiaries of IRAs that are planning to pay out the amount every year, a trust is really not a drawback. It could be a benefit as far as knowing what distribution options you're going to allow with the trust. Now, you don't
Okay.
necessarily have to allow the trust to distribute income. You could have the trust pay taxes on it. It really depends on what your intent is with the trust. I mean, if it's to keep it out of the hands of creditors, potential spouses, in-laws and outlaws and all that kind of stuff, I mean, that might be something that you would consider is having the trust pay the tax and then having discretion on when to distribute it. But in
Okay.
general, I think an IRA's beneficiary or trust is beneficiary of an IRA is fine. I think when you have a non-qualified annuity and having the beneficiary as a trust, I don't know what benefit that really provides. Certainly not a tax benefit. It may be some
Sure.
other distribution type of benefit, but you're only limiting yourself when you make the trust the beneficiary of the non-qualified annuity. And I know very few good reasons why anyone would do that.
All right. And one last question on the non-qualified funds dealing with the 5-year rule that you can also do a stretch on.
Mhm.
Uh, what would prevent someone from doing a stretch and say, the nationwide peak 10 allows that, but at
Mhm.
the end of the 10-year surrender charge period, what's stopping them from just taking the money and cashing the whole thing out and basically bypass the 5-year rule, but didn't technically stretch it over their life? Is there anything that stops them from doing that?
Let me follow here. Are you still in a trust scenario, or are we just looking at
No,
individual?
no, just
Okay.
individual.
No, no. I mean,
Okay.
with a traditional, non-qualified or IRA, you can always take more money out, and you just be taxed earlier. So,
Okay.
there as far as if you're trying to limit what the individual beneficiary can take out, there are some special forms. You mentioned Peak 10. It does have a beneficiary restriction form that allows the owner to say, hey, the beneficiary can only take out this much. They have to take it out over a certain number of years. They have to take it out over their life expectancy, and they're not allowed to take a lump sum distribution. I mean, there is a form that will allow you to do that. But unless that form is filled out, they can take money anytime they want, any amount they want. Yep.
Okay. Good deal. All right. Today's recording will be posted to our Brew blog and emailed to advisors later. Now for the giveaway. Ken, if you can pick a number between 1 and 25.
Let's try 17.
17. All right. That is author. Winner today's author, congratulations. Be on the lookout for a complimentary CE voucher and a Starbucks gift card that will be coming your way from all of us here at E4 Insurance Services. On next week's Brew, we continue the Annuity Awareness Month with myself and one of E4's regional vice presidents, Josh Meester, who will present on the recent success advisors have had capitalizing on higher rates and COLA riders to provide a unique solution in solving for RMDs. Thanks, everyone, and we will see you next week on the Brew.